Hi guys, in this short recording, I just want to talk about a joint venture, what it is, what it means, and how you can get into property with little or no money, or be able to partner up with somebody who's got the skill set to be able to help both of you make money. My name's Adam Panisi. I'm involved in a couple of $100 million of my own property development projects. I also help other people with their development projects through my education, through a company called Liberty Blue Wealth. So joint ventures, some people might be familiar with them. If you're not, all it means is that you partner up, or two or more people partner up with different skill sets, different attributes, and then you come together, you collaborate to then complete whatever it is that you want to complete. In this instance, it's property investment or property development. You might see it at the big end of town, like with civil construction companies. You'll sometimes hear that there's a multi-billion-dollar project and two companies have come together to joint venture. And normally what that means is that project is too big for one of them to do by themselves. So they've come together. They may have different skill sets, where one might be a specialist in one type of this job, and then the other one might come in and be a specialist in another type. So all it is just marrying up your skill sets. So what that means for property development, and this is absolutely gold, this is where I first started, and this is where if you're just starting from ground zero, either with no skills or no money, you can start by doing joint ventures. So first of all, you need to find a joint venture partner. That in itself is most of the challenge. You need to find somebody that has something that you're missing. So if you're starting off with no money, well, you need to find somebody that's got money. If you're starting off and you don't have any serviceability, but maybe you're sitting on $500,000 in the bank, then you can partner up with somebody that does have serviceability. If you have money in the bank, you may have serviceability, but you just don't know how to do a project, or maybe you could consider partnering up with somebody who's got a few runs on the board, that has completed a few projects before. So there's a number of different ways to do it. You can do a joint venture if you're just starting, if you're already been doing it for a little while. I've still got joint ventures on the books. I've got one property that's in a joint venture arrangement. All the other ones are purely 100% my own. Some of them backed by investors and high net worths and financial institutions. So all a joint venture means is that you collaborate together. So I want to talk about a specific example. When I first got started, my very first property development, I got a vendor to vendor finance the entire project. Then I needed some additional capital to complete the development. So I got a $300,000 vendor finance. And if you haven't listened to this story, I encourage you to listen to how I first got started, where I bought a $1.1 million project. That was the purchase price of the land. It ended up being a $3 million end value project. I completed that using none of my own money. I got a vendor to vendor finance, $300,000. Then I found a joint venture partner who came in and financed an additional $300,000. So in that instance, I brought the joint venture on as part of the company. They were ownership in the they had an ownership in the company, and that was how our joint venture was arranged. So they took a share of the profits and completed the project, and there's certain rules and things that are followed. Many of the things in a legal contract is more about dispute resolution. So going into a joint venture is key. Spelling out the rules of what's going to happen, and a lot of that needs to be centered around not so much when things go right, but it's more so when things don't go right, don't go according to plan. So who has the final say? So who's the director of the company that's controlling the entity? Controlling the property? Who as a shareholding and what are the shareholders' rights. So you could be a director of a company, but if you've got less than 50% shareholding, whoever controls more than 50% shareholding controls the company. They can appoint or fire the director of the company, but while the company is in operation, the director has control of the bank accounts. They can turn the bank accounts on or off with the shareholders. So if you are in a joint venture, just remember that the director has 100% control. It's only that the shareholders can kick the director out and appoint themselves if you've got majority shareholding. So going into a joint venture, if you are going to partner up with either one person or a company, just make sure your values align. And in the early days, I did some great joint ventures with people. We made money. Both joint venture partners were happy. I did a couple of other joint ventures where they didn't go so well. We still made money, but what it came down to was the joint venture partner wasn't happy that I made more money than them, because that was what was agreed to in the joint venture. And then I've had other joint ventures that haven't worked out, mostly on the back of different values. And that's one lesson that I've learned over the course of business and even just in life. If your values differ, then at some point those two different values or two opposing values, if they're significant enough, are going to play a real part in any sort of conflict. So I have had joint venture partners before where our values misalign, things like work ethic, how we manage the project day to day, the expenditure of the project, bringing in investors to the project. Values misaligned, and as a result, those joint venture partners or those joint ventures didn't proceed through to the end, or when they got to the end, we never did another one after that. We just got to the end and it was completed. So if you're looking at doing your first joint venture, don't just jump into bed with somebody just because they've got the money or just because they've got serviceability. Get to know that person. It's like a marriage. You'll be dealing with that person. You need to know that when things don't go according to plan, because sometimes they don't, that you've got either a backup plan or you're going to execute the original plan. The other thing I found is joint venture partners overpromised and underdelivered. So just set out the exact rules of what's going to happen. So who does what, and make sure your skill sets complement each other. There's no point in having two engineers running a project and butting heads. There's no point in having two salespeople or two real estate agents running a project and butting heads unless they have different skill sets. So just marry up with somebody who's got opposite and opposing skill sets that can complement yours if they're both inactive. If they're a silent joint venture partner, then make sure that it's stipulated that they're silent. And if you're giving them monthly updates or 6 monthly updates, whatever it is, make sure you stick to that. So a lot of it does come down to communication. If you're always communicating whether things are going well or especially not as well as planned, if you're always communicating, things I've found will always work out. So that's a little bit on joint ventures. Let me give you another example on one of my other projects. In the early days where I did a joint venture, I didn't put up any of the money. I had a money partner. So I was the serviceability. I was working as an engineer. I was making good money. So I had plenty of serviceability, but I didn't have the cash. I found a joint venture partner. He wasn't working. He was doing property full time, but he had heaps of cash. So he was sitting on $500,000 or something like that. And we did some smaller projects together, and each project that we went into, we would do it as a profit split. So off memory, I recall I did a 60-40 split. So I was 60, he was 40. He put up all of the money. He was purely passive. We would catch up weekly, monthly, or weekly when things were happening, if they were like moving fast, or otherwise it'd sort of be monthly. Just remember, this was in the early days, and my projects or project timelines for a lot of the cases were only 3 to 6 months. So single houses or multi, like 1 into 2s, that sort of thing. So project timeline were a lot shorter. So if you can imagine, when things are happening, like we're selling stuff, I'm going to be updating him like every week and saying, hey, we got the sale, hey, we're about to settle, or if we're constructing, hey, we're at lockup, hey, we've got titles or about to get titles. So he was purely passive, but he just wanted to know that things were being managed. So our split was 60-40. I was 60, I was doing all the work, and ultimately I had the risk of bank debt, and I was providing my serviceability. He came in with the money. Now, one thing that I've learned is that there's plenty of money around, whether that's institutional money, private money. Money itself is a commodity. You can always find it if you've got a good deal, right? I mean, if you've got a good deal, you've got to go out and look for it. If you've got a great deal, people are generally going to come to you, but they need to know about the deal and how good it is. So you need to put it in such a way that you can show people how good that deal is. And I don't just mean like a 1-page hand-scribbled notes. I'm talking about, yeah, maybe that might be okay as a summary, but professionally formatted, showing people what the return is if they invest in this, or if they come in as a joint venture partner. If you are splitting the profits, you need to have a sound way of working out the profits. So the expenses need to be noted. And if you're managing the project as the director, you're ultimately in control or in charge of the expenses. So once the expenses are wrapped up, really to calculate the profit, that should be done by an accountant, and preferably you nominate that accountant in the joint venture agreement and both parties are happy with it. So at the end of it, the accountant has the final say as to what the profit is and what the split is. I hope that's helped you guys out. When you're looking at your next joint venture, don't go in there with any set rules or stipulations, but just to give you a guide, and I've heard heaps of people ask this, the guide around, well, what is a fair split? As I mentioned, my joint ventures were 60-40, where I was the project manager. There would be sometimes some management fees, and then the money partner would come in, they would make a 40% profit margin, and that seemed to work quite well on smaller projects, and I did a number of these with various different parties. Now, there's some other strategies which differ a little bit from joint ventures, which I'll explain on separate videos, and how I transitioned from doing joint ventures when I first started. For the first 3 or 4 years I was doing joint ventures, then after that I got into doing some other things where I brought in money partners in a different way. So I hope that's helped. And when you're looking at your next property deal, think about how you can partner up with somebody, or if you need to partner up with somebody to either reduce your risk, or if the project's too big, or you just want to work with somebody. You just want it to be a bit more fun, and just not just you out there slogging away and not being able to enjoy your wins with anyone else. So I hope that's helped. Enjoy the rest of your day, and if you have gotten value out of this, follow what I'm doing. I'm planning to post a lot more free videos with tips and tricks about the strategies that I've learned over the last 11 years. And if I have helped you, or if you've got any further questions, just comment, let me know, or send me an email direct, and I will endeavor to respond to it as soon as I can. Thanks, and have a great day.